Welcome back to another case study. I'm glad you're here. We're gonna have another case study. If you guys have liked these, I have a whole playlist of them. I'm not gonna jib jab too much. Here we have January 4th, and as always, I'm a developing student. These are just my interpretations on price. Let's get straight into it. So I was here on Nasdaq. What are we doing right now? We're rebalancing or we're repricing to this imbalance here. We have a lower imbalance to the low right here. So we have a possible area that we want to rebalance lower as well. Maybe trade up to these wicks, maybe something like that. Maybe trade to the order block, which is what I probably would expect. Or we could possibly retrade higher. We have a higher time PDRA, so we need to see what the structure is going to give us to see if we maybe want to reverse from this area. But overall, what are we? We're bearish. We might want to trade back in this breaker to then head lower again. So it all depends on what price wants to do, and we need to see lower time for structure to really confirm that, and we want that all to be aligned. As we see here on ES, what are we doing? We're retrading lower within this imbalance here, maybe around constant encroachment of that imbalance, and that's kind of where we end up trading into this daily imbalance here. And notice how on ES we created an immediate rebalance. We failed to create a bearish value gap here. So if we want to displace lower still, we will end up probably likely displacing lower still, and then possibly retrading to this imbalance, and then within the market. So if we consolidate here, if we maybe consolidate, then we probably will want to see higher prices because we're failing to react off that immediate rebalance. All right, and here is a 15-minute chart on ES. As we can see here, we have taken sell side, then we come back up, we reprice to this kind of order block right here, this big up close candle here, and then we end up having a fair value gap in, fair value gap out. We leave this as a breakaway. This is balanced price range, and then we end up displacing lower to these lows here. And here we have a 5-minute chart of ES. Where is the low resistance liquidity at market open? And also we have this 12 a.m. opening price. I know, kind of all over the place. We have 12 a.m. opening price. We end up manipulating below that right at a certain time. Notice what ends up happening here. And then it looks like we have 8:30 news. I didn't really note that news. I'm sorry. But we have 8:30 news. Ends up manipulating lower here. 9:30 opens up with sell side already taken. So what are the probabilities? What are the probabilities of us displacing much lower here at market open? We also are in a higher time repeater rate. We don't really care about this price action right here. We don't care. We don't care about this. Note that we also are within a daily imbalance. So what is the probability of price? Like, what are we more likely and more prone to do here, at least in the short term? We're gonna reprice all this low resistance liquidity, all these failure swings with the market, all these stops here. Notice as well, we also have this imbalance above market price right here that hasn't get traded into. So this could be a high probability draw on liquidity. And that's exactly where we end up repricing to. You don't need all this extra stuff. We end up coming into this order block here. But we don't need all this. We don't need this extra stuff. We just need something that's consistent and something that repeats. And that's what ends up happening here. Market open. Where's the low resistance liquidity at market open? Every single day. Where is low resistance liquidity? Where is it? Right above highs. Where's high resistance liquidity? At the lows. Where are we likely going to reprice to? To the highs. Simple as that. And here we have a 5-minute chart zoomed in. We end up taking sell side right at market open. And then we end up changing the state of delivery here on the 5-minute. And notice the reason why I would use this wick is because it's with a gap. So if we have an order block and we have a wick that lines up with the gap, that's when you use the wick. That's when a wick gets used with an order block. But right here, since it's just a down close candle, normally I would use the body, but since we have a fair value gap overlapped with that, I would use the wick because that's going to be area of fair value. So we end up coming within here. We also have fair value gap in, fair value gap out. I know I've been saying that a lot, but that's kind of the signature that I like to see. Kind of just simplify it. Fair value gap in, fair value gap in, fair value gap out. We should not really need to spend any time at these lows. And we end up repricing straight to this buy side here, and it being a nice buy model. And then we end up doing a little bit of extra work here, and then we end up displacing lower and then selling off throughout the rest of the day. And here is a 4-minute chart. As you see on the 5-minute chart, that order block had a wick, but on the 4-minute chart, it becomes a nice defined body that ends up becoming clear. And look at that. That's just beautiful delivery of an order block. If you want to know what a good order block looks like, it's that. You want to see that. So we end up coming into sell side. Smart money is really accumulated within here, within this down close candle. Then once price trades above it, we end up coming back down into that order block, and then boom, and it just explode, or not like directly after, but we pretty much make an explosive move here. All right, and here is a 1 minute chart of this fractal in price. Here's what it looks like on the lower time frame. We end up having this imbalance here. We end up creating 1, 2, 3, 4, 5 relative equal lows here. The reason why we don't really care about this is because it's not at a certain time. We end up kind of having a false breakout here. Oh, like breakout traders are enticed here. People think it's gonna go long, or they might get fearful of this move here. We end up taking buy stops to then just end up coming back down to this 1 minute fair value gap, taking these sell stops here. That's your turtle soup right there. In my opinion, turtle soup. Sorry, I shouldn't really talk about turtle soup. I stopped. I used to talk about turtle soup every second, but I slowly stopped using turtle soup because I know there's like the whole CRT thing, and I haven't really researched too much of that because that's not how I like to really trade. But we're coming in here, we're taking sell stops here, and then repricing higher. Here you have the 950 macro. When does this move start? The candle of the buy side repricing starts right at 950. That's just wonderful to see. And then as you can see, this move kind of ends around 1050. Then we end up kind of consolidating here. It's a very nice macro that we're offered here. Low risk liquidity at the highs. What's more probable? What's more probable? Screw like trying to be right. What's more probable? It's more probable that we head to highs. It is more probable. If we do end up coming to these lows, that's just the risk that you have to accept, and you just got stopped out. It'll probably repeat tomorrow. That's why I want to do these fractals in price of this day going on and going forward, because it'll probably just repeat tomorrow. Probably will repeat the next day. Notice here how we have that higher time PD rate. We have this low here. This now becomes significant because we have an immediate rebalance. This now can be kind of framed as a PD array. And notice how we don't have like a nice like hourly imbalance, a nice 15-minute imbalance that we're rejecting off here. We're rejecting off of this low. That now becomes your PD array. So right here, we actually end up forming SMT at these highs here. Fair value gap in, fair value gap out. We now have sell side that rests within here. That now can become a draw on liquidity. And notice here within this model, we end up having buy side get repriced to within an hour and 52 minutes. And then sell side becomes a lot more slowed down, a lot more consolidation, a lot slower, and it takes a lot more time for this to happen. So although this can be traded and you can look to take this as a market maker sell model, I personally don't really see this as a need to trade it, but you obviously have your own opinion, and you might see this as, oh, this is exactly how I want to trade. I'm not here to influence. I'm just here to have case studies. All right, here we end up having that PD array that gets traded to. We end up breaking down, kind of have a early market structure shift, which would be a change of state delivery there. Then we end up having this fair value gap that gets traded to. We have a fair value gap in, fair value gap out. This inversion gets traded right to. We end up offering resistance there. Now it becomes sensitive right there. And then we come into this area of mitigation here, and then we end up kind of just lackluster move. Again, we have this order block here. Why am I using the wick? Because it overlaps with the fair value gap right there. Boom, 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 boom. Like the reaction off that level. And boom, we end up selling off to this low here right around 4 p.m. All right. And here we can frame standard deviation. We also can go over this a little bit more. We have SMT. We put in a failure swing. We break down. Boom, right there. We trade in that for value. I need to stop saying boom. And then we end up having that's that inversion fair value gap right there. We end up having a fair value gap within here. A 1 minute fair value gap overlined with this mitigation block right there. Sorry, the standard deviations kind of overlapped right there. Then we end up trading lower. And here we have a breaker high, and then we have the breaker low. I'm pretty sure that was on this is the 5 minute breaker. We have the last down close candle before taking buy side. So this comes to breaker high and then the breaker low. So that's what I'm marking out here. So here we have that breaker. We end up accumulating within here, and then we end up displacing lower. And then just look at this. I don't really care to be in something like this. I'd rather be in something like this to where I have confidence in. But although it is a little bit slow in its delivery, it's still there. The price is still gonna move, like we know it should, and that's what we end up doing. We end up repricing lower to sell side. Notice here, standard deviation, reaccumulation zone gets respected. Possible reversal retracement area doesn't really get respected here. We never really have a significant stop hunt within this model either. Normally, I would like to see a stop hunt around 50% and then see some form of displacement. So the fact that we never had a stop hunt within this market maker model just gives me a little bit suspicious vibes, and I think we might want to see higher prices within the upcoming days because we have all this generated liquidity that will likely get taken. So yeah, as we see, that's that. Then we have another standard deviation. We have just this fulcrum point right here, and then as you see, you can send out that reaccumulation zone, and that's right exactly where we end up displacing lower and having that silver bullet. Notice here we flirt with this level. We have a trade higher, and then we have 1 2 equal lows here, and we trade back up into this imbalance right here, and then we end up within that reaccumulation zone. All right, here you have your lower SPY, first stage, second stage, third stage, I guess. I don't really like to, as you guys know, if you guys keep up with my opinions, I don't really like to look at price within the context of low risk buy, low risk sell, and then first stage, second stage. I just look at it as this is distribution, 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 distribution. As we can see, old areas of accumulation should become new areas of distribution. Boom, right there, distribution, right there, distribution. And as you can see, if you extend this level out in time, we end up having distribution right there. And overall, as you can see, this is the profile that we had, the daily profile. We end up having a 930 Judas within the market. Or not really a 930 Judas, but 930 puts in the low. 950 macro becomes a good candidate for a long entry. And then we have 1120 puts in the high. And we end up breaking down, and then we end up having a market maker sell model. So there's that. Yeah, and that's that fractal price. Hopefully you guys like these. If you don't, it's cool. It's whatever. I'll keep on posting these, and I'll see you guys within the next one. Peace out.